One of the most important controls a company has over their cash is a bank account. Cash is easy to steal, so you want to make sure that there are several controls that are in place to protect cash. A bank account has several controls in place. First, there's a signature card. A signature card is where the bank has a list of all the signatures that are authorized to sign for this account. So if a check comes through that has a different signature than the ones on the signature card, it will not honor those checks. The next control is a bank statement. The bank will send a statement of all the transactions that occurred on your account during the month. So whatever the cash receipts, whatever the cash payments that went into your account, they will summarize it and send a statement at the end of every month. That way you can compare that to what you have in your books, in your ledger, and verify that all the transactions that occurred were authorized transactions. The next control is a deposit ticket, which is every time a company goes and deposits money or checks in the bank account, they will give you a summary of all the deposits. That is a verification, that's a documentation of what you deposited in your bank, and you can compare that with any accounting records later on. A bank reconciliation is a very important control device, which we're going to talk about next. Finally, a check is also a control device. If somebody withdraws money from the bank account using a check, there is a paper trail, and those can also be compared against accounting records. Let's take a look at a bank reconciliation in more detail. For a company that has a bank account, there are always two records of a business's cash. The first record is the cash account in the general ledger. That is where you would have entered all your cash transactions during the period. The second record is the bank statement. The bank also has a list of all the transactions that hit your cash account in the bank. Every month, at the end of the month, the bank will send the company a bank statement. That bank statement will have all the cash receipts that went into the account, all the cash withdrawals that were withdrawn from the account, and other items such as bank charges and fees. When the business receives the bank statement, what they do is they compare the bank statement to their cash account, their general ledger account. And if the ending balances are the same, that means that every transaction that hit your books has also gone through the bank, and then there's nothing to do. Everything is fine. However, that is very rare. The bank statement and your general ledger accounts usually have different amounts. And the reason is because of the time lags in recording the transactions. And we're going to take a look at how time lags occur next. All a bank reconciliation is it's just a statement that explains the differences between your general ledger, the cash in your general ledger, and the cash that you have in your bank account. I need everybody to be very, very clear that a bank reconciliation is just a schedule prepare to explain the differences between your cash account and your bank statement. It's not a T account, it's not a general ledger account, it's just a schedule we prepare to reconcile, which means explain the differences between your cash account and your bank statement. Let's take a look at an example to see what I meant that a bank reconciliation explains the timing differences. We are Alex Inc., the company, and we bank at Brady Bank. So let's take a look at the example. Alex Inc. has a cash account. Investors invested $10,000 cash in the cash account, and then for that transaction your journal entry is going to be you are going to debit cash for $10,000 and you're going to credit your common stock account for $10,000. Now that is what the entries that we make in our journal and then post to the ledger. But in practicality, what is Alex Inc. going to do? What are we going to do? We're not going to keep that $10,000 cash lying around, and most likely we didn't receive cash, we received a check. So what we do, the first thing we do is we go to Brady Bank, which is where we bank. We open an account and we deposit that $10,000 into our bank account. The minute we do that, Brady Bank will open an account. Now we are a customer. So we have a customer. They'll have an account for us called Alex Inc. And Brady Bank, now remember, this is what Brady Bank would do for the transaction of us depositing $10,000. What Brady Bank would do is they would debit their cash account for $10,000 because they just received cash from us for $10,000, and then they would credit our account, our customer account, which they would show as a customer, and we are Alex Inc. Our $10,000 is a liability from the point of view of Brady Bank because is it Brady Bank's money? No, it is Alex Inc.'s money. Does Brady Bank owe us that $10,000 anytime we need it? Yes, they do. That is a liability in Brady Bank's accounts. Now let's take a look at the next transaction. The next transaction is Alex Inc. bought equipment for $1,000. So in our books, we are Alex Inc. Remember, we are going to debit our equipment account for $1,000 and credit our cash for $1,000. Again, typically when we pay cash, it's by check. So we will give a check to whoever we bought the equipment from, and they will go and deposit it to a bank account, which will withdraw the money from our account in Brady Bank. That's how banking systems work, right? So we wrote a check for $1,000 because we paid $1,000 cash to buy our equipment. Now, when that check hits Brady Bank will say, oh, Alex Inc. has paid $1,000. We don't owe them that $1,000. We will pay to the person they bought the equipment from. So what they're going to do, Brady Bank will debit $1,000 to the customer account. Now Brady Bank only owes us $9,000. $10,000 minus $1,000 is $9,000. So for every transaction that we have that is cash, Brady Bank will have a mirror image of our cash account in their books. Let's do a few more transactions. For the next few transactions, I will not show you both the debit and the credit side for Alex Inc. and Brady Bank. I will only show you what goes on the cash account. Always know that every transaction has to have an equal and opposite reaction. So every time we do a debit or a credit to cash, there would always be a debit or credit to another account in Alex Inc. The next transaction, let's say that it occurred on the 10th of January. Alex Inc. paid $2,000 cash for rent. So Alex Inc. would have debited $2,000 to rent expense and credited cash $2,000. The landlord would have gone and deposited the money in his account. So when that check hit Brady Bank, Brady would have debited our account, which is the Alex Inc. account, for $2,000, and they would have credited their cash account. On the 15th of January, let's say that Alex Inc. earned $5,000 revenue, and it was cash revenue. So what Alex Inc. would have done is debited their cash $5,000, credited revenue $5,000, and when we went and deposited that money, Brady Bank did their journal entry, which would be debit cash, credit Alex Inc. All I'm doing in this example is you're seeing two sets of books, one for Alex Inc. and one for Brady Bank. You don't need to follow the journal entries. Just know that for every entry that we have for Alex Inc., there is a mirrored image in Brady Bank's books. That's all you really need to understand from this journal entries. Next, on January 31st, Alex Inc. had cash revenues of $6,000, which again they went and deposited in Brady Bank. You made the deposits late in the evening on the last day of the month. By that time, Brady Bank had already printed out their bank statement. So the bank statement that they send you did not have that $6,000 reflected in their bank statement. It did not hit their account till the following day, which is February 1st. Next, let's say that Alex Inc. had salary payments of $3,000 and expenses of $500 that they wrote checks for, but again, those checks were not presented to Brady Bank until February. These checks were written at the end of the month, and they were not presented to Brady Bank until February. Therefore, the bank statement that Brady Bank sent us at the end of January did not have those transactions. That's what we mean by timing lag. Let's take a balance of our cash account. Our general ledger cash account has a balance of $14,500. Brady Bank would say that our cash account had a balance of $12,000. See how they're different? In our records, we have $14,500. That is our general ledger account. But Brady Bank's bank records say that we have a cash balance of $12,000. There is a difference between the two. So what we need to do is create a bank reconciliation to explain the difference between our two records of cash. Remember, the difference of these two are simply because of timing differences. Timing differences being we deposited the $6,000 at the end of the month in January, but it did not hit the bank until beginning of February. And that is what we mean by a timing difference. So let's do a bank reconciliation next. A bank reconciliation is a schedule that we prepare. So it'll say bank reconciliation and it'll have a date, which is the end of the month, January 31st, 2012. A reconciliation will have two sides. It will have a bank side and a book side. So you're going to reconcile both numbers to come to the number that balances out. We always start bank reconciliations with the ending balances. So on the bank side, which is right here, we put the ending bank balance. Our ending bank balance is $12,000. That's our starting point. On the book side, we also start with our ending book balance. Our ending book balance is $14,500, and that's what we start off with. Now next, what we're going to do is find the items that were in our books that did not hit the bank. Since there are only a few items, you can immediately see which items didn't hit the bank, but let's go through the procedure that you would normally do if you were dealing with a ledger account and a bank account that has thousands of transactions every month. You would start off with comparing every item in your ledger to the items on the bank statement. So let's look at the first $10,000. Both those $10,000 show up in your ledger and your bank statement, so that is not a reconciling item. Let's look at the next one, the $5,000. Again, they're both there in the cash, in your cash account, in your general ledger, as well as your bank statement. Therefore, it's not a reconciling item. Let's look at the next one, the $6,000. Now that is showing up in your general ledger account, but it has not shown up in your bank statement yet. So that is a reconciling item. Now, whenever you're preparing a bank reconciliation, the rule of thumb is put it where it is not. So put it where it is not. Where is it? It's on the cash side or the book side. Therefore, down here in your reconciliation, you're going to put it where it's not. Therefore, you're going to put it on the bank side because that's where it is not at. Now, let's see what we would do with the $6,000. The bank says our bank balance is $12,000. Should this bank balance be less or more than $12,000? Well, it was a deposit that did not hit the bank, so our actual cash balance should be greater than $12,000. So we would add that $6,000 on the bank side. Put it where it's not. It's in the ledger. It is not in the bank, so we're going to put it where it's not. And we're going to add our $6,000. Deposits that have not hit our bank yet are called deposits in transit, and we add them to the existing bank balance, the ending bank balance in our bank statement. Now let's continue and look at all the other transactions here. Next, we have $1,000. That $1,000 also shows up in the bank statement, so we're good. Next, it's $2,000. That also shows up, so it's not a reconciling item. But the next two, the $3,000 and the $500, do not show up on our bank statement. It will be realized later. Since those items are not there in the bank statements, they are reconciling items. Now our question is, which side do we need to put them on? Do we need to put them on the bank side or the book side? Remember, your rule of thumb says, put it where it is not. You found it on the books, so you are going to put it on the bank side, where it is not there. We call these checks that have not cleared the bank yet outstanding checks. Now, what are we going to do with these outstanding checks? Are they added or subtracted? Should your cash balance be more or less? It should be less because these checks were money going out of the bank account, right? So we need to subtract those. Outstanding checks are subtracted to come up with our cash balance. So when we add deposits in transit and subtract outstanding checks, we get an adjusted bank balance of $14,500. Now, we're not done yet. We just did the books. Basically, we looked at all our ledger account and identified every single transaction and compared it to our bank statement. Whenever you're doing a bank reconciliation, you have to do the opposite as well, which means you have to take your bank statement and compare that to every single item in your ledger account to see if those were there. Now, since you've already identified one side, what you need to do is go and see what items were there in the bank statement that were not there in our ledger. In this case, everything in the bank statement was in the ledger, so we're okay. But sometimes you find certain things such as bank charges that we would not know about until we receive the statement. So those would go on the side that is not, therefore those would be shown on the book side. Right now, there's nothing that was there in the bank statement that was not there in our book, so our adjusted book balance is also $14,500. Now, we've reconciled our bank statement, which means our adjusted bank balance and adjusted book balance are equal. The next question is, and you'll find this typically in your quizzes and exams, what is the actual amount of cash that Alex Inc. has? The answer is $14,500. It is whatever amount that your bank reconciliation ends up with. That is the amount of cash that this company has. These are the things that you would normally find on the bank side of the reconciliation. We would have deposits in transit, which you know that these are deposits that the company have made that have not hit the bank yet. And if there were any bank errors, you would also adjust the bank side of the reconciliation. The bank errors are the only item that would not fit into the rule of put it where it's not. If it's a bank error, then you would put it on the bank side of the reconciliation. So this is an exception to that rule. On the book side of the reconciliation, you would find items that were on the bank statement that you did not know about until you received the bank statement. And here's a list of things that you would find on the bank statement. Bank collections. Bank collections refer to customers going and depositing money straight into the bank, so the bank collects money on your behalf. Very similar to that is electronic funds transfers, where bank collects money by for online banking transactions, or if a customer sends money through a wire transfer. Remember, electronic wire transfers can also be money going out, not just coming in. Service charges, any service charges that the bank puts to the company will be shown on the bank statement. Interest revenue, any interest that the bank pays for the company will be shown in the bank statement. And non-sufficient funds checks. These are what we call hot checks. This is where a customer gives us a check and there's not enough funds in the customer's bank account. So the bank returns that check and takes money away from our account, take that money away from our account. If we printed checks, any cost of printed checks, and then any book errors. Again, book errors are the only item that will not follow under the rule where I said put it where it's not. book errors would be put on the book side of the reconciliation. All these other items would be found on the bank statement, and you put it on the side that it's not, which is the book side of the reconciliation. This slide shows a summary of all the reconciling items, and this would be something useful for you to either copy or print from your PowerPoint and bring to class, or have it with you if you're an online student doing your homework and as well as your quizzes, because that will help you determine which side each item goes on. Once we prepare the bank reconciliation, there is one more item that we have to do. You know that everything that we found on the bank statement, we put on the book side of our bank reconciliation. We did not find out about those transactions until we received our bank statement. Therefore, every single item that we listed on the book side of the bank reconciliation require a journal entry. The reason we need to do that is because all the items on the book side, again, were found on the bank statements. They had never been entered in our journal and posted to the ledger, so we need to prepare journal entries for those items and post them to the ledger. Be sure to practice several bank reconciliation questions so that you are comfortable with what goes on each side when you're presented with quiz questions and your exam questions.